So in this set of sessions, we are going to basically work around the valuation exercise of Maruti Suzuki, India's largest passenger vehicle firm. Maruti effectively sells nearly half of India's passenger vehicle volume every year, and it has been a dominant force over the last many years. And we're going to try and attempt the valuation of this particular firm as we go along. Now, there are going to be substantial data points that we're going to use as we go along, which we will look at in the Excel file that is accompanying with this session. But just to kind of reiterate, there are going to be a certain set of things that we are going to look at during this process. How do we go about doing this? We already have data on the profit and loss account, balance sheet, ratios, and some other data about the company and the industry. We have historical data which is available. So that's already available. We are going to use this to find out what are the major revenue and cost drivers of the company. And we're going to make simplistic assumptions around that and use that to create a forecast for the company. We are going to then use this forecast to forecast cash flows for the company. When we are doing this forecast, we're obviously going to learn a little bit about what's going to be the industry structure, what's happening with the industry, and so on and so forth. Once we get to the cash flows, we will get into the actual valuation bit. The valuation bit is going to be twofold. It's going to use DCF and it's going to use relative valuation. And in DCF, we're obviously also going to spend a little bit of time trying to find out how do we get to the discount rate and what kind of cash flows are we going to use, right? Relative valuations, we're primarily going to use PE and EV by EBITDA as metrics. So that's the broader contour of what we're going to do around this. Most of the time is going to get spent in this bit, which is finding out what are the major revenue and cost drivers and trying to kind of look at what's the kind of forecast we will build around the company. So that's the broader contour of what we're going to cover in the next few minutes or sessions that we're going to look at. In terms of the broad understanding, remember that this session is a quick way to build a framework around analyzing any company. You could always refine it more at your end. Do understand that this is a limited time in which we are trying to address this problem. So obviously it might leave some moving ends at the end. That's okay. You could use that at your end. We will cover the valuation completely, but you're free to kind of use and play around with the file and try and play around and change the numbers and see what happens if the numbers change. You're free to refine that further as well. But we are going to build a quick framework around it and kind of arrive at some sort of a broader, template which could be used for valuation of any company at any point of time. Two, there is a standard disclaimer. This is not to be seen. This is not a recommendation to either buy or sell the stock, right? So whatever the target price comes, the entire idea around this is purely educational in nature. So please refrain from using this as a direct advisory or suggestion for buying or selling the stock. That's not the purpose. That's not the idea. We're going to look at how do we go about doing valuations. Obviously, in the context of things, we're going to revise some of the parameters that we've already seen or learned about at this point of time. So that's broadly the contour of our discussion. And we're going to begin with our broad analysis. Let's first spend a few minutes trying to understand what we mean when what's the data that is available with us in the file that is available, right? So you will see the profit and loss statement that's available from 2016 onwards, and the numbers are in INR millions. So effectively we are going to work with millions. That's the currency that's the unit the company uses to kind of report. So that's what we're going to continue using it. Maruti as an entity has nearly about 80,000 crore or 820,000 million of sales. 82,000 crore of sales is the value for Maruti last year. In terms of their profitability numbers, they end up making a profit of somewhere to the tune of 7,800 crore or 78 billion rupees, right? That's the size and scale of Maruti as an operation. That's what we see. Profits have been increasing, though last year wasn't too much of a growth in the profitability terms. Last year was also a disruptive year in terms of GST coming in. Sales growth was reasonably healthy, right? And margins were healthy. What you do see is a little bit of change here or there in terms of excise duty, etc. Because if you look at numbers closely, excise duty was about 92,000 million for the year 2017. That's only 22,000 here. That's because it was only available for a quarter, beyond which GST took over. Now GST is above this line item. So all the data that you see is net of GST. GST should have been somewhere here. So the company reports these numbers net of GST, and that's the contour of what we are looking at as we look at the data, right? So that's the broad contour of their P&L. If you look at their balance sheet carefully, again numbers in millions, and you look at the balance sheet first, the sources of funds. Few things strike us very strongly. There are no loans, or roughly about 10 crore of loans. So a company which is virtually debt free and running the operations based on that. The company also kind of has a little amount of current liabilities, trade payables of about 10,000 odd crore. Remember, this is in millions, once again repeating that. Total balance sheet size of the company is about 60,000 crore or 602 billion, right? So that's the size there. On the asset side of the company, bulk of this 602 billion comes out of something called as non-current investments. This 349 billion or 35,000 crore rupees approximately is just pure investments in debt funds, which is nothing but cash equivalent for the company, right? So that's a cash equivalent for the company that you see. These are going to be investments that the company holds 35,000 crore worth of cash at this point of time in the context of their balance sheet. And so consequently is a cash rich company, is going to be very healthy in terms of the balance sheet parameters that you're going to see. There are also going to be some other parameters that you're going to see, which could be things like anything that is not classified as debt could come under stuff like other long-term liabilities. For example, a lease agreement that you have gotten into could come here, and those could form a part of other long-term liabilities. Any kind of long-term money you have collected from someone in lieu of, let's say, renting out a premise as a deposit for a longer period could be a long-term liability. So that's about 1,500 crore if you see, which again on the size of the balance sheet is roughly about 5%. So that's not huge in the context of the overall balance sheet. Bulk of the balance sheet comes from share capital and reserves and surplus, which is equity holders' money. So practically healthy balance sheet numbers in that context for this company, right? There is nothing on the cash flow sheet right now. We're going to build that as we go along, because we are going to need this primarily for projections in the next year. There are ratios which are calculated. Again, reasonably healthy set of ratios, which you would spot and see. Operating profit margin has been fairly stable. Net profit margin largely stable, going a little bit down in the last year, but that's fine. Most of the metrics in terms of return on equity, return on asset, return on capital employed, the formula for each one of them is given. You can try and look at those and play around with those. The company does not keep too much inventory, neither has too much receivables, right? So turnover ratios on both receivable, which is sales by receivables, and sales by inventory are high. Basically, if you go and look at what is a receivable, sales that you have done but not received money on those account. So on 820 billion of sales, if you look at the total receivable number, that's about 14,000. Right, so meager amount of receivables, roughly about less than 2% of receivables exist. Inventories are about 4% of sales or something of that sort. So very small inventory. Maruti is known for not keeping inventories, and Maruti is known for obviously it's a B2C kind of a business. So you pay and then get the car. So effectively, there's not going to be too much receivable as well in that contour. So ratios would look healthy once again. Very little debt in the context of long-term debt by equity. Interest coverage was fairly healthy, which is how much money do you have to kind of cover your interest. That, however, goes down dramatically this year. Unfortunately, what's the scene is at this point of time, we do not have the annual report for 2018. They do report a substantially large, by comparison, substantially large interest cost in 2018. We don't have a breakup of how did this come and what did this come from, because only in the annual report will we see notes that are available there, right? So from that perspective, this data point is has to be kind of assumed to be an exception at this point of time. They don't have debt, so probably they took debt in between and then repaid it during the course of the year. That happened. Having said that, this is still about 350 crores on their size and scale of operations. So not really too much to worry about at this point in our context, right? Those are the data points. There are some other ratios. You could read about that and look at them as you go along, right? Let's move on to data and assumptions. We have some data which is available from the annual report, some from other sources, some from the data point which is there. So if you look at this data, there is a capacity number which is available with us. So till last year, Maruti used to have a capacity of 15.5 lakh cars. This year, that capacity has been increased at 18 lakh cars, right? Typically, the capacity increase has been priced in general. Just going back a little bit about the low receivable scenario of the auto industry, either you pay for the car or the bank pays for the car. What is the relationship between you and your bank has got nothing to do with Maruti. So even if you take the car on loan, the bank is making an upfront payment to Maruti, right? In fact, the dealer is making an upfront payment to Maruti and you are doing your arrangement with the dealer and the bank. So technically Maruti will not have receivables in any context, right? This is the capacity. They are increasing capacity. They've increased by about 2.5 lakh cars this financial year. And that's going to come in, that's already upstream at this point of time. That's working at this point of time in Gujarat. They're expanding it by another 2.5 lakhs next year. And the land that they have in Gujarat, the Gujarat facility that they have, can be extended up to 15 lakh cars capacity. So they can practically double it from 15.5 to 30 lakhs, just expanding every year with capacity expansion. So capacity is not a constraint. What are the sales numbers that you see around Maruti? So if you look at the sales numbers, Maruti had about 12.9 lakh cars, and we have domestic and export numbers. Export numbers have been largely stagnant. They've not really done too much around export numbers that you see. And domestic numbers are available here. Which have grown very healthy in a very healthy kind of a framework. 11.7, 13.05, 14.4 and 16.53, which results in overall car sales growing at a very substantial volume. So volume growth has been reasonably healthy for these guys. In fact, if you look at this set of data, I can just drag it on the left hand side and you will get what kind of volume growth has been there. Domestic sales growth has almost always been extremely healthy in terms of double-digit growth. Exports is stagnant. Overall growth is near about 10% or slightly higher than that at most points of time. So pretty healthy set of numbers that you see. Now, another intriguing or interesting part about Maruti is their market share in the country. So if you look at total cars sold in India, that's about 26 lakhs in 2015, going up to about 33 lakhs close to the end of 2018. And out of this, roughly about half is what Maruti sells. In fact, we can actually just calculate the market share. So all I need to do is divide the domestic number with the overall number, divide that with exports, and that for the overall data point. And so what you see here is Maruti's market share in domestic sales has consistently increased 45 to 46, 47, 50. That is remarkable considering the size and scale of the company, that at half the market already, they are continuously increasing the market share in this market, right? Exports, on the other hand, have been fairly stagnant. So export market share has gone down. In fact, the larger exporters from India are companies like Hyundai and Ford Motors. But Maruti is probably at a third or fourth number in terms of actual export volume that they do. So 7.5 lakh cars exported every year from India, and nearly about a little bit less than that, less, about 1.25 lakhs is what Maruti exports. Overall share in total sales, export plus data, this is 44%, right? So approximate numbers in terms of market share, but exact numbers in terms of sales, etc. Where do we get this data? Now there is a set of reports which you'll have to go through. Annual report will give you sales numbers, volume numbers, but it may or may not give you capacity numbers. Not all companies reveal capacity. Maruti has not revealed capacity in their annual report. Capacity, however, can be found if you do a simple Google search. You will get a sense of what is the capacity of Maruti. Those numbers are available. They report it, right? So you could go through their quarterly results, their communication around quarterly results. They may have communicated around that. Industry data is available on a variety of news reports. Once again, it's a collated data that you would have probably done over a period of time, collating from various news reports, various data sources. What you see here is a very concise format, but there is something called SIAM, which is an SIAM, which is an auto body that would give you domestic data at least. So the SIAM data is available at all points of time. Every month you get data about data sales, which is car sales, which is available here. So to that extent, you will have to do a little bit of digging up in terms of getting this data. That said, it's not very difficult to find this data because this is a fairly simple and straightforward industry in that context for data to be kind of taken out, right? So that's the scenario that we see here. Now we turn our attention towards specifically trying to project what do we think is going to be the revenue driver. Very simple, straightforward business. We could dig deeper in terms of what kind of share do they have in terms of each of the segments that they have. They do give a little bit of input about that on their quarterly presentation, where they, for example, tell us that what is their segments and what kind of sales do they have in these segments. The problem is that they do not give us the pricing of each of these, so we can't really rely on that. The only thing we can probably check is that certain segments are growing faster. So you'll see that UVs are growing at a 29% growth rate and compact cars are growing at a 28% growth rate. Mini, which is Alto, etc., is growing at a lower rate, so that's slowing down. Mid-size is slowing down, but their growth rate primarily comes from compact cars and the UVs, which is the Vitara, Brezza, Nexa, etc. Everything sold through the Nexa channel is growing remarkably well for them. Logically, there should be a premiumization which is playing, and so consequently, if you see that premiumization playing out, what should be evident is that their revenue per car should go up, right? If they are selling more premium cars, their revenue per car should go up. Now, as I said, unfortunately, we do not get data for prices of various segments, so we will have to rely with a single number, which is revenue per car. I'm going to find this in INR. How do I find this? I will take the net revenue and I'll take the net number, which is below the excise duty line. So net revenue per car divided by the total number of cars sold, right? I can find that. So let's go to 2016 because we only have data for 2016 which is available. So we're going to look at 2016. We're going to look at the data with respect to the P&L, which is net sales. Let's look at net sales that's available here. Net revenue from operations 575,890. And remember, this number is in millions, so I'm going to convert this to rupees by multiplying with 10 raised to 6, right? So I've multiplied with 10 raised to 6 and I divide this by the total number of cars that Maruti has sold. So that's available here in cell number D11. So I put this and the number is about 4 lakh per car. That's the average pricing that Maruti is able to extract. That's about 4 lakh per car, right? If I drag this further, we were expecting premiumization. We do see premiumization, right? So in the next year, the number has grown to 434 and we continue to see that premiumization in the next year as well. So average pricing has gone up to 4.48 lakhs from 4.02 lakhs. And that could be looked at in terms of what is the growth that you see. And so every year realization has basically gone up. And that's a good sign. Basically, the company is able to kind of increase realizations, and that data is playing out, right? So that's how you calculate revenue per car. Very simple calculation. you basically pick up the P&L revenue, net revenue from operations, multiply with 10 raised to power 6 because you want to convert it to rupees. That was in millions, you convert it to rupees, divided by the total data and assumptions, which is the number of cars sold, and you get about 4 lakh rupees on average blended revenue per car. Right now, that's a simplistic assumption. It's much simpler for us to put this number next year as a forecast and project the volumes next year, and we should be able to get the revenue of next year. Let's actually do that as a simple calculation. Let's assume, I'm going to assume a 3% jump, and yellow cells that you see are going to be forecasts. So I'm going to assume a simple 3% jump in terms of revenue per car, and just add that. This is a forecast number, remember. So everything that you see on the right of 2019 is going to be forecast. If you want to use another color, you could use another color for that. So that's the revenue per car. I can also assume what is going to be the growth rate of the industry. Right now, what would be intriguing is that domestic sales growth is expected to be about 9% CAGR. Again, if you read a little bit of reports around this, for the next few years, in fact, till about 2025, you would expect this kind of a growth. So I could just expect a 9 to 10% kind of a growth in the initial few years and then slow it down a little bit. And that should basically give me a sense of what is going to be the numbers here. So I can actually just predict, let's assume I assume a 10% kind of a growth here. So I'm going to put a number at 1.1. That's going to be the number of cars sold next year. Just for argument's sake, let's assume I'm going to use the same metric for exports. So I can get the total number of sales. I now need to make a projection of what is going to be the market share of Maruti. No reason to believe that Maruti is going to lose market share. So I'll keep it at 50. And let's assume that they're going to kind of stay at 16% or so in exports as well. So I'm just going to put in these numbers. At this point, we are not really debating these numbers. We're just trying to build the framework. So if I now have this set of numbers, I can actually calculate what is going to be the volume for Maruti here. That's 50% of the total market. That's 36 lakh cars. So I get 18 lakh cars sold next year. What is the volume in exports? That's 16% of 8,21,000 cars. So that's this. The total volume sold is 19 lakh cars. Right? Next year capacity is going to be about 20.5 lakhs. So they seem to be utilizing once again nearly 95% of the capacity. But if they grow further, they will need to do some capex in the subsequent year. Right? This should be 2020. They'll need to do some capex in the subsequent year. Now you have what you see as the total number of cars sold next year. You also have what you see as the realization per car. Technically, you can calculate the net revenue for next year, right? So if you want to project this in the P&L, I can, and I use the number of net revenue because all next year excise duty is not going to be there because GST has taken over, and GST, as I said, is above this line item. They don't really count GST here. Sales tax, etc., is all above this line item. So next year onwards, you're not going to see an excise duty number. So I'm going to calculate the net revenue from operations. Look at the formula. That's going to be the total number of cars they are selling, which is 19.39 lakhs, multiplied by the price per car, which is 4.61 lakhs, and I have to convert this to millions. So I'm going to divide this by 10 raised to power 6, right? I have to convert this to millions. So I'm going to divide this by 10 raised to power 6. That gives me my value at 8,96,000 millions, 896 billion, or 89,600 odd crore. That's how basically I go ahead and project the data. In fact, I can just select this set of data and shade it in a different color just to kind of showcase that this is a projection that we are doing. So 8,96,000 millions is going to be the sales. That's basically how you arrive at putting this number. You are converting rupees into millions, and so you're dividing by 10 raised to power 6, right? So that's your revenue per car. Broadly, if you're going to kind of go ahead and implement the valuation of Maruti, that's about it that you need in terms of your overall set of numbers that you need, right? Now we move one step ahead and we look at the costs. So one of the interesting things that you see on the P&L, look at the size of the total cost in terms of raw materials, purchases of any kind of stocks, etc., that come in, and changes in stock in trade. So if you add all these three, basically that's the total raw material cost that the company has. If you add these three, the total number is about 550 somewhere about that billion, and out of 677 billion, that's nearly 80% of the total cost. So bulk of the cost comes from raw materials for an entity like Maruti, right? Once again, almost all of these costs can be calculated in terms of a per car basis. So there is a cost driver. We are looking at INR million numbers. These are the actual numbers that we are seeing, right? So let's just put these here. Cost per car can be calculated as dividing each of these line items by the total number of cars sold, right? So I'm going to basically take raw materials here and convert it to rupees, 10 raised to 6, and divided by the number of cars sold. Simple calculation for each of the cells. I'll need to freeze this bit, and remember, I need to freeze the row but not the column, right? So I get this, I can drag it on this side, I can do a Control C, and I can do this. So that's all that we get, right? This is in INR. This is rupees per car. So basically for each of the cars that you see, roughly 2.5 lakh is just straight away your data point which comes from raw materials. Purchases are essentially things you are buying directly and putting in the car and then selling it off, or using as spare parts that you're buying and selling on your own. So effectively these three portions put together are going to give your total raw material cost for Maruti per car. That's about 3 lakh per car. They're selling the car at 4 lakhs and you're getting the cost at 3 lakhs. Employee cost per car is about 15,000-16,000 rupees. It's not a very employee or labor intensive industry. Other expenses, which would include selling, general and administrative expenses, are going to be about 56,000 per car. That's the data that we have. We could actually look at an increase in these, and if we can make an assumption roughly about these numbers, then we are basically going to look at the data points and work around that, right? So that's the broad contour of the company, and the numbers, obviously we can assume what kind of growth is happening. You do see an increase in salary, and we can actually just insert a few rows and see what kind of growth rate is happening in this. So I'll just insert about, let's say, a few rows. Let's just look at growth, and let's look at all these numbers put in. I'm just going to copy and paste these, and all I'm going to do is check the growth rate of these year on year. So has the raw material cost gone up or gone down, right? And you go down further here and you drag it on the left side. Obviously 2015 data is not available, so that's what is available with us. You can ignore the ones which are changes in stock in trade and all. That's obviously going to be volatile because it's a small number. What is changes in stock in trade is, let's say you are using up your existing inventory or you are piling up inventory. It's a concept which comes because you are essentially going to kind of either use old inventory or have an inventory at this point. This concept comes because of a concept called matching of the revenues and costs, right? Take an example. If I have 1,000 cars raw material bought in, right? And let's say raw material per car is 3 lakh per car, right? So what would be the total raw material cost? 30 crore or 300 million or 3,000 lakhs. That's the invoice that is generated, right? Now let's assume I did sales of 900 cars. So the sales number would be, and let's say sales was at 4 lakh per car. So the sales number would appear as 3,600. But when you look at the raw material cost, the invoice, because you bought raw material for 1,000 cars at 3 lakh rupees each, would appear at 3,000. So your accounting system will show you 3000, right? But that doesn't look at things correctly, because technically you are doing sales of 900 cars, but you have accounted for cost of 1000 cars. That doesn't make sense. So what do? You check at the inventory level. Inventory, let's assume before this event was 0. From 0, if you have sold 900 cars, the last 100 cars should be left. So inventory should go to 300, right? So change in stock is subtracted. So you do a minus 300 here. The combined value of these two will be 2700, which is the cost of 900 cars. So that's why you adjust that change in stock number there. That's what we did there on our Excel file. So you combine this with the raw material cost basically, and that gives you the overall spectrum of what is going to be the raw material cost per car. And you add purchases to this because there are some things you directly purchase and put in. You don't manufacture it as such, right? So you put those things as well in the car and you plug those numbers in. So this is a meaningless number, doesn't really matter too much. What is interesting is that on an overall level, if you add these three, the number is about 2,97,000, which here has become 3,08,000. So that sum is what we are interested in. In fact, if you want, I'm just going to do that sum here. Let's just do a sum of these three and look at this, right? So there was a substantial jump here and then a minor jump here. So raw material cost pressure is obviously there. If you read a little bit about steel prices and all, they seem to be going up at this point. So that may be one of the reasons that explains what this cost jump is. So that gives you the data point here. I can assume a certain amount of cost jump here. Once again, at this stage, we are not really looking at what is the exact number that we want to plug in, because we are more worried about a framework building at this point of time. So let's assume a certain amount of raw material cost jump, which is inflationary in nature. So I'm going to put 5%, 5%, and 5%. Employee cost jump has been 7 to 8%. So I would continue expecting about a 7% kind of a jump in employee cost. Other costs have been fairly stable. So I'm going to keep that at 0. And the final portion, which is own use vehicles. So they use some of this for their own use, right? So they subtract it from there. So I'm going to keep that as 0% as well. Now, once that is available, I can predict what is going to be the number on a per car basis next year. So that's this into 1 plus 5%. And I can just drag it down and all these numbers would be available. We can just combine this. Remember, this is essentially on a per car basis at this point of time. There is no basis of these assumptions at this point of time. I've just plugged in numbers so that we can complete the framework. Once we have completed the framework, we can sit and break our head exactly over why these numbers are in the yellow shaded cells are coming from where, and why are we putting those numbers. Obviously, there's a lot of research that needs to go into that, and we will be restricted by time and scope of this entire presentation. But you could always play at your end with these numbers and do a sensitivity around changing, let's say, raw material cost from 5 to 8% and see what happens, right? So that's the broader contour of data which is available. Now, given that we have these numbers, I can actually predict these costs based on a per car basis. We know the sales volume, right? We've made that assumption earlier. So I can look at the raw material cost, multiply it, this is per car, multiply it with the total number of cars sold, which is here 19.39 lakh cars, and divide by 10 raised to 6. Why divide by 10 raised to 6? Is because we are converting rupees into millions, correct? In this, I need to freeze the row of the cell where the car is there. So I do $11 and I just drag it down, and that essentially multiplies each one of these headers with the sales volume in cell G11, right? And that gives me the eventual costs. I can actually just go to the P&L and plug in these costs from the data and assumption sheet and put it here. Once I do this, I can get my net revenue, I can get my costs which are there, total costs, and once I have these two, I will have my operating profits which are available with me. So technically, we have looked at these three numbers, and these numbers are now available with us, at least in the form of a framework. We are not yet sure if they are 100% correct or not correct, and we may not be able to check everything in the scope of this particular session, but at least we are aware of how do we go and project the P&L as such, right? That takes care of the P&L largely up to a certain line item, which is basically your EBITDA or operating profit, right? So your cost drivers and your revenue drivers are largely in place. Now, what numbers we want to do it, we can go and dig deeper and find out how much steel is used per car, how much aluminum is used per car, what is the price happening there. All that we could debate, whether they are adding employees, are they cutting employee cost, adding employee cost, what kind of increase in realizations is there. All these yellow cells that are there are assumptions. These are hard-coded assumptions that we have used. In any company's valuation modeling that you do, there are two broad tasks. You first have to arrive at what is going to be the driver. So you have to arrive at the driver first, and that's the most important task that comes in. And then the second part is the forecast around those drivers. Obviously, when you're doing a forecast, it has to come from a lot of understanding of the sector, a lot of understanding of the company. So right now, what we are worried about is, can we build a framework, a template that can be used to value? But over a period of time, what we would definitely urge you is you go and read a little bit about the sector and the company and try and refine these assumptions as you go along, right? We have done revenue and cost drivers that basically allows us to build the P&L till a certain point. We will look at other income when we reach there. But now we need to get into the balance sheet line items, right? And try and kind of make a forecast on some of the line items on the balance sheet. Now the balance sheet could be divided into broadly three different segments, right? So those three segments are long-term assets, long-term liabilities, and current assets and current liabilities. So most of your current liabilities and current assets will get projected using what are your working capital assumptions here, right? So we will get to that in a minute, but that's going to get projected from there. Your long-term liabilities on the balance sheet that you see here are basically either share capital, reserves and surplus, which comes from your P&L statement, or loans, etc., which in this particular case, we're not really too much worried about because the company doesn't have too many loans, right? Some other line items. So for example, if you want to look at long-term liabilities, and once again, we are a little bit handicapped at this stage because this data point of 2018 is available in the company's financial results, but you don't have a breakup of this which is available because the annual report is not available. So if you want to look at what is this long-term liability, you can go to the annual report of 2017 and look at that 11055 number, right? Let's actually go to the annual report of 2017. You have to look at the consolidated statements, which would be somewhere around here on page number 206 in the annual report. You will see the consolidated statements. If you go down, you're going to see, let's say, other non-current liabilities. That's the number we are looking at, 11055. That's available in note number 20. So I can now go to note number 20 and explore what is this line item. Right, so let's go to note number 20. Notes follow in the annual report after all the data points that you see. So these are the other liabilities that you see. Non-current is essentially something called as deferred revenue, right? So this is essentially revenue that they have pushed forward in that context, and that's a liability that is there. Now the problem with this is it is extremely difficult to project this in actual life, right? So unless you are like an insider for the company or you know in and out about what's happening with the company, it's really difficult to go ahead and project it. So whether we like it or not, things like deferred revenue, things like what kind of advances come or statutory dues, etc., that come, some of these line items we will have to assume that they remain constant in subsequent years as well, right? So that is where you're going to basically live with and work with and play around with that as you go along, right? So practically from that perspective, we could actually go and signify which of the data points we would like to keep constant as we go along and which of the data points we want to kind of dig in as we go along, right? So that bit we will look at and understand as we go along. Also remember that in the context of your assumption building, always follow what is the Pareto principle, 80-20. Only 20% of the numbers are going to have 80% of the impact. So for example, this long-term loans and advances line that you see, which is 2 million out of the size of 600 billion of the balance sheet, don't worry too much about this number. If you know it, great. If you don't know it, just put the same number as last year. In fact, any line item that is less than 1 to 2% of the total balance sheet size, there's no real benefit in really spending too much time trying to analyze it unless you think it could become a bigger number at a later point of time. There is an endless number of assumptions you're going to make when you're going to do valuation of a company, and you will never be certain about it. That's the reality with respect to equity valuation. If you were certain about all these numbers, then you were effectively investing in a fixed deposit, right? The whole fact that you are not certain about it makes this exercise extremely beautiful, in the sense that my numbers might be different than your numbers, and consequently we will all arrive at a different set of data points with respect to analyzing the company. It is absolutely imperative that we understand that we will never have certainty in these models. So don't break your head too much over line items, which are smaller line items that do not really impact things too much, unless of course you can get data around it. If you can get data around it, nothing like it, great, right? But the whole idea is that you are going to basically look at this data in that data point, right? So based on that, you are going to build in the entire assumption and play around with numbers and put in those numbers. Also, always remember that valuation as an exercise at the end of it is going to give you a template that tells you whether you are grossly correct or incorrect about the number. It cannot give you out one single price that you say is the correct price of the stock of Maruti. That's a difficult outcome of this. And in fact, you can never have that outcome with complete certainty. And so you have to be aware of the entire point of what your limitations are while trying to evaluate a company, which is why there is a market that exists for equities. When someone is buying the stock of Maruti, someone else is also selling the stock of Maruti. So one person believes that it's undervalued, the other person at the same point of time believes it is overvalued. If both of them were working with the same set of assumptions, there would be no trade. The stock will remain where it is, and no one will be willing to sell or buy that stock at that point of time. So obviously there is a mishmash of assumptions that play through in real life, where my assumptions could be different than your assumptions, and so consequently you are looking at those numbers coming in here. Now in the context of balance sheet, what we are going to do is keep some numbers the same. Some are logically going to be the same. So your share capital doesn't change unless the company issues more shares. That's going to remain consistent, right? I'll come to reserves and surplus. Let's keep minority interest where it is, right? Don't worry too much about it, because debt is not too much. I'm going to keep that there. Long-term liabilities, we will come back to this, but for the time being, I'm going to keep all of these constant, right? Let's build the framework and then see if we can change anything out of this. All these numbers we're going to bring from our working capital assumptions and play with that. Long-term assets will come from your assumptions around capex. So you need to understand what is the amount of capex the company is going to do, and that is going to give you your long-term assets as they come in. The other assumptions around non-current investments, technically non-current investment is a cash equivalent. You could treat this number as cash, or you could keep it constant, doesn't matter. Just keep these line items constant for the time being. Other non-current assets is also something that you might want to kind of check in the context of the firm. So let's look at what's going to be the other non-current assets. So let's look at the balance sheet quickly. And on the assets, you see this other non-current assets in note number 12. You have to go to note number 12 and identify what these other non-current assets are. So let's go quickly to note number 12, cash and bank balances. And then you have other assets, which could be prepaid expenses and leases, amount already paid under protest or dispute, right? So you've paid it, so kind of created a sort of, provision around it. You've already made a payment, but this is under dispute. You could actually get it back. is what the company has basically declared. So these are the numbers. Again, very difficult to actually project these for next year. So you assume that either they will be a certain percentage of the balance sheet and you keep them there, or for the time being, just keep it simple and let it be the same as last year. For the purpose of this exercise, let's keep it simple and let's keep it there. Now, there are two broad items that are required. One is the long-term assets calculation, and the second is the working capital calculation. So let's do the working capital calculation. Now, what are these assets? So think about it. If you are basically building a company and you're running a business and you do sales of 100, if you do sales of 100 and you have an inventory of 10, then it's logically expected that for sales of 200, you'll need inventory of 20. If your receivables are 20 when sales is 100, then you expect that receivables as a percentage of sales kind of remains constant. So an interesting idea would be to look at all the current assets and current liabilities with respect to their movement against the sales numbers. What is the revenue number? And find all of them as a percentage of sales. Usually, good companies try to keep them constant as a percentage of sales. So we can try and check that if Maruti actually keeps them constant as a percentage of sales. For the purpose of this, what I'm going to do is I'm just going to introduce the revenue from operations line here. So I'm just going to copy that from the, or link that to the P&L and put that number here. Net revenue from operations. Let's put it here. So calculations are simpler. Now all I need to do is inventory, which is here, as a percentage of sales. That's all that we need to do, right? So I'm going to freeze this and freeze only the row, not the column. So I do this, that's about 5%. And when you drag it on the right side, we said that good companies try to keep it constant or decline it marginally. That's what the company has been trying to do. You don't need as much inventory, so you're reducing it. Look at receivables, exactly constant the last 2 years. If you look at some of the other ones, you will find that barring a few changes here or there, most of them move within ranges. So a good company will try and manage it within ranges. A not so good company will obviously have numbers which are moving all over the place. It becomes difficult to understand companies that have substantial movement. So look at payables. That's about 12.5 to 13% of sales at all points of time. So you kind of get a sense that, okay, look at the short-term provisions. They're always about 0.7% of sales. Look at these liabilities. That's about 1.7 to 2.1%. So never do you see a very big variance in terms of these numbers, which basically brings you to a sense that the company is trying to actively manage all these numbers as they go along, right? And that active management is basically playing out because you are assuming that the company is going to continue maintaining that. A very simple exercise could be that you have to assume these numbers for the next year. What is going to be the percentage of each of these line items, and what is going to be the percentage of each of these line items, right? As a percentage of sales, you already have the sales number, so that's available. I can basically take some of these as on a declining trend. Let's be conservative, keep it where it is. And where you have a range, then basically we could probably take an average. In fact, I'm inclined to kind of keep everything as it was because it's not moving too much on a broader scale. It's a small percentage, 0.1, 0.2% here or there on the overall context of sales. So it doesn't really change things dramatically. You could also, for example, take an average. If you are not 100% certain about the numbers, you could just take an average as well, right? So I'm just going to keep it the same as last year for the time being, which will allow us to project all the numbers here. So now that we have this, I will have my inventory percentage multiplied by the revenue, and again freeze the row and just drag it down. Because you have assumed a certain set of data points as a percentage of sales, and you know what the sales are, you could basically get projections of these numbers here, right? I can go and immediately plug in these numbers there on the balance sheet. I will do that in a minute. So that's my working capital scenario. Note that there are two line items I have ignored here. Line item 1 is cash and bank balances. That's been ignored. Line item 2 is investments. That has been ignored. Why have these been ignored? Because these are cash equivalents, and when you're doing working capital analysis, you ignore cash, right? So obviously the investment part I'm going to keep constant as last year, and cash is going to be my balancing figure, but not a direct hard-coded balancing figure. It'll come from the cash flow. It has to come from the cash flow statement, right? If everything goes fine, the final number on my cash flow statement should actually balance my balance sheet completely. Rest of the numbers are available. I can actually just plug in the inventory data here, which is here. Line item just below that is receivables. I can plug that in. Loans and advances. I just need to be a little bit careful with this because there are some blanks in between and I've removed some numbers here or there, but you could plug in these numbers and put it there. Same is the case with all the current liabilities. Liabilities is simpler because all of them are there. Just plug in all the numbers and put them there, right? So that basically feeds in the data. In fact, your liability side on the balance sheet is done, right? This doesn't add everything because it does not have reserves and surplus as of now. I'll bring the reserves and surplus in as well. So let's close that out first. How do you get reserves and surplus? That comes from your P&L. So right now we don't have line items around depreciation. We don't have line items around interest, and we don't have line items around tax. Tax could actually just be a simple straightforward 30% into profit before tax. And so that gives me this number. And I can get to profit before minority interest and share of associates as this minus this. There's some share in associates that comes out, which we will come back to separately, but let's keep that constant as of now. And so you add these two numbers, you get the profit before minority interest and this number here. So I can do that. That's my P&L completed in the context of all the numbers that are available. Obviously, we are yet to put in the numbers around depreciation and interest. We'll come back to that as we go along. But for the time being, this is the data point that we have. The profit that the company has, assuming that the company does not give a dividend. If they give a dividend, you assume a dividend and knock that off. But let's assume for the minute that there's no dividend that is there. In the balance sheet on the reserves and surplus side, you're going to add last year reserves and surplus plus the profit that comes out of this year. So as you feed in more numbers there, it'll automatically change the number. That gives you the number of reserves and surplus going up to 5.13 lakhs, millions. So this is 513 billion essentially. Total amount goes to 710,896, right? What is left is on the asset side. So one final thing that I would want to show you is how do you go and figure out what is going to be the capex, right? There are two things that can be done. One of the things that can be done is you could go back and look at the gross numbers of the company in terms of the gross fixed assets, right? And the gross fixed assets number is again available in the notes to accounts. You will not find this directly. The number that you see on the balance sheet here in the asset side is a net number. So this is after you have removed the depreciation, right? But if you want the gross number, that you will have to find out from the balance sheet, from the annual report, and there is a notes to accounts in the annual report, you can put that. This is the cost value, historical cost value. We don't have numbers before 2015 because in 2015 onwards, companies started reporting using new accounting standards. And so numbers before that are strictly not comparable, right? The tangible gross fixed assets and intangible gross fixed assets or long-term assets of the company add together to give this number 15,000 crore and 18,000 crore. Can I find out assets per car capacity, right? Remember, this will be on capacity. So I can take this. This is in millions. So convert this to rupees and I can go and just divide this number with the total capacity that Maruti has, right? So you get assets per car capacity. That's about 98,000 and you get about 1,20,000. So basically what you're saying is that if Maruti comes and says, I'm going to increase capacity by 1 lakh cars, they're going to need 1 lakh into 1,20,000 per car, which is going to be about 1,000 crore of capex, right? So they don't need too much capex. So for example, if you have to increase capacity by this 2.5 lakh cars per year, how much would you need, right? So just think about it, 2.5 lakhs. So I can just multiply this per car, 1,20,000 into 2.5 lakhs divided by 10 raised to 6. That's in millions. That's in millions, remember, right? So 3,000 crore is what they need. And what is the profit that Maruti is making? Maruti is making nearly 9,000 crore of or 8,000 crore of profits. So technically, all their capex can just be funded by internal accruals. They don't need anything, right? That's broadly it, what we would cover in this particular session. We will continue with this in our subsequent session.